Welcome to Finland's. In this video, we are going to discuss what is private equity, different asset classes, and ILPA, PPM, and LPA agreements. So let's begin. An asset class is a group of similar investment vehicles, different classes or types of investment assets, such as equity, fixed income, cash and cash equivalents, investment funds, and alternative investments. What is an equity asset class? The equity asset class is a fascinating one and has been gaining popularity in recent years. Investing in equity means buying into a business. When you buy shares of a firm, you have a percentage of ownership. The only hitch is that it comes with a certain amount of risk. Any business takes time to grow, and it is subject to market fluctuations, which can impact the share price. Let's move to fixed income asset class. Fixed income is one of the most popular and the oldest forms of investment option. It includes corporate and government bonds, corporate debt securities, asset-backed securities, etc. Such asset classes typically invest in debt securities that endeavor to pay investors interest until maturity. The third one is cash and cash equivalents. Cash and cash equivalents give you easy access to your money and don't typically require a lot of upfront costs. They are widely considered low or no risk since the capital put in is guaranteed but offers lower return rates than other asset classes. Some cash equivalents are also considered fixed income investments. Examples: money market funds, treasury bills, commercial papers, bank account balances, guaranteed investment certificates, etc. The fourth asset class is the investment fund. It is an investment fund that is an alternative option for investors who are not interested in choosing or trading specific stocks. Investment funds are a basket of investments, a collection of stocks, bonds, or both that typically focus on one or more asset classes. For example, mutual funds, index funds, ETFs, etc. The last one is alternative investments. In alternative investments, there are two main types. First are private assets such as private equity, private credit, infrastructure, and private real estate. They are more complex and less frequently traded than public stocks and bonds, and give investors access to additional sources of return. Hedge funds, the second type, operate mainly in public markets but use less traditional tools such as short selling and leverage. There are three broad types of asset classes based on risk: lower risk, moderate risk, and higher risk. Lower risk assets are usually more stable. They are less likely to lose money and returns on the investment will be lower over the long term. Moderate risk assets contain a combination of higher risk and lower risk assets. Higher risk assets have higher expected returns and the risks of losing money are increased, especially over the short term. Let's understand what is private equity investments. Private equity investments typically aim to create value in private businesses by financing growth, operational improvements, or other changes. Combined with active ownership, longer time horizons, and financial leverage, those changes may produce higher returns than are common in public equity. To invest in a company, private equity investors raise pools of capital from limited partners to form a fund, also known as a private equity fund. Once they have hit their fundraising goal, they close the fund and invest that capital into promising companies. Documents to be aware of before starting the private equity journey, that is ILPA, PPM, and LPA. Let's start with ILPA. ILPA, the Institutional Limited Partners Association, engages, empowers, and connects limited partners to maximize their performance on an individual, institutional, and collective basis. ILPA publishes a variety of industry guidance for LPs and GPs, including the Private Equity Principle, Model LPAs, and fund reporting templates. ILPA is a trade association for institutional limited partners in the private equity asset class. The next one is PPM. PPM stands for Private Placement Memorandum. A private placement memorandum is a document that is put together by a privately held company when seeking to raise money from investors. The PPM is designed to illustrate and disclose the structure of the investment terms. It also outlines the risks and potentials that come along with investing in security. Additionally, the PPM document can be used as an opportunity to convince potential investors that the security is worth buying. The last one is LPA Limited Partnership Agreement helps protect your business into the future by outlining each partner's roles and responsibilities, as well as how they share in the business profits. We should use a limited partnership agreement if you want to form a limited partnership or formalize an existing limited partnership. I hope you learned new things and this video added value to your time. If in case it does, feel free to give this video a like and subscribe to our channel Finlands. Thanks for watching. If you want any guidance or clarification in this video, kindly comment below. We would be happy to answer them. Till then, stay healthy and stay connected.